Welcome to Small Business Exit Strategies. Today's webinar is going to be from Small Business Solver, the team here. And basically, Small Business Exit Strategies, the big thing that we are going to be talking about today is that if you really want money now, that means you should probably be getting a job. So this is something that some people forget, and that everyone's thinking that, you know what, I want to have my own business, I want the flexibility, I want more time to myself, I want to be my own boss, and I want to be making my own money, so the money that I earn is right into my pocket. But really, a lot of those are fallacies. I mean, they're false. And what I mean by that is that you might actually have more flexibility in your time, but having your own business doesn't actually get you more time for yourself. And then if you want to actually make money and it goes in your pocket right now, actually a job is more likely to do that because it doesn't take into account all of the startup costs, hiring costs, and all the other little costs that you don't really see as an employee. So what are we going to be covering? There are actually 6 small business exit strategies out there for us to be leveraging, and we're going to do an overview of how each one works, an example of that, and then one key to success for each of them. So there definitely is a must-do for each of these. And why is an exit strategy so important? Well, again, if the way to make money is actually to get a job today, so if we want money now, it's all about getting a job. Why an exit? Well, what you do get from your own small business is the equity. So you continue to grow your business and you build equity, you build value and worth in your company, in your business. So if you don't have an exit plan, you don't actually realize that. You never get that big bonus at the end for selling your business or doing any of the other exits that are here. So you need an exit to realize the value of your company. So these are some types of exit strategies that are out here. There's the golden parachute, the liquidation, selling to another entrepreneur or buyout, a merger or acquisition, and then there's an IPO or an initial public offering. You'll notice there's only 5 here. Well, we have a secret number 6 at the very end. But we're going to jump into each of these. So number 1, what we term the golden parachute. Basically what this is that you're fully leveraging the fact that you're running your own business while you're running it. And really you don't have a future goal of maybe selling it and making $1 million or whatever your goal is here. Is really what you're doing is at the time of owning the business, you're actually paying yourself the large salaries, large bonuses, and you're writing off a lot of expenses. And the expenses might be things like traveling expenses. If you go to Florida and you have a client in Florida, now you got a great trip to Florida, but you also got to write some of those off as expenses in your business. So this is basically fully leveraging being a business owner. And some examples of companies that we've seen do this, and Nike is actually not one of our own examples. It's one that we've actually researched and read that other entrepreneur.com have actually said that they are the ones to do this. So, and another one is there's actually a transportation company that has done this historically, is basically they do pay themselves the big salaries. For a transportation company, obviously they have clients all over the place, so being able to take clients out for dinner and things like that, they're able to then use those expenses to really enjoy their life as fully as possible as an entrepreneur. And with the golden parachute option here, what you must have, key thing for this type of exit strategy, which really you don't have a final exit, it's just maximizing what you get out of your business as you're in it, is basically a great tax accountant. Realizing what you can write off, what you can't write off, and definitely staying within that threshold. A great tax accountant would also help you if you need a tax shelter. So they would be able to create that for you. Maybe you don't actually need RRSPs. Maybe you can create your own tax shelter. And basically asking these questions to a great tax accountant would be critical if this is your plan. So plan number 2, this is the liquidation. This is the simple stop, just liquidating or selling all of the assets of your business when you're ready to do that. And a good example of this would be a restaurant. So let's say a restaurant has been in operation for 20 or 30 years. The owners, they're ready to retire. really a restaurant business, you need the tender loving care. Maybe their kids don't want to run it, all these different things. So they're ready to sell it. And kitchen equipment, many of the different things like tables and chairs in a restaurant, they would actually be able to really leverage that and make some money and exit properly by selling and liquidating all of the assets, especially if they own their own property, something like that. But really, there's a lot of equipment, a lot of value in their company that they can sell to another restaurant owner. And it's such a big market that it's very, very possible, because so many people are starting restaurants, that it's not that they have to find one or two people. It's thousands of people who might be potential buyers for this type of equipment. The top do for this is realizing that you do have value in your assets. In fact, some companies that go bankrupt or are selling and liquidating everything, they actually make a ton of money from closing. So realizing that all your shelving, all your fixtures, if you have a retail company, whatever it is worth something. Everything's worth something. And basically realizing that and not just selling to the quickest or fastest buyer, planning it out, doing your research, and understanding how much value you actually do have. So exit strategy number 3, pretty much the obvious one. Can we just sell it? Well, you can sell to someone that you have a relationship with, because selling your business isn't overnight. It's something that really is going to be someone who trusts you, someone who has a lot of questions on your financials. You would actually help them maybe on the training side. Examples of this would be maybe a cafe. There was one that just happened actually in Vancouver, where one organization bought a cafe from someone who had been running it for a couple of years, and they basically got all the equipment, all the fixtures. They took over the lease and things like this, but they actually really had to understand why the existing ownership no longer wanted to continue operations. So there has to be a bona fide reason, not that the business isn't working. No one wants to buy that. So it is a relationship based. It does take some time. Another example would be a dental office. Often when a dentist decides to retire, they actually sell their office. And again, this is something that it would take some sort of relationship. Probably the dentist who's planning on buying it would start working there for a bit. Maybe the dentists then have that relationship maybe over a period of time, and then the new dentist would then eventually buy the dental office from the person retiring. And often this could be upwards of $500,000, even more. And of course, the new dentist would really want to understand the operations, understand if the organization is actually profitable. And this is a common exit strategy within the dental office industry here, so for dentists. The top do here is really to start early. Start targeting who the potential buyers are early. And by understanding that, you start from the get-go of saying the right things to them. I mean, you probably don't want to complain about running a business to your potential purchaser. You probably want to be already marketing to them and telling them how great it is and that type of messaging. You also want to make sure that you at least have maybe 5 people in mind, not just one that you're actually speaking to about this. And that creates a sense of competition, a sense of urgency on their side, and it increases the chance that you're actually going to have a buyer who's ready when you're ready to sell. So the key thing here is start targeting these people early. The next one, acquisition. So this is acquisition or merger. This is when another company just comes in and buys your business. And really what this is they are looking at your business strategically as someone to buy out. And a great example of this is Instagram. Obviously it was just purchased by Facebook. It would be when Google purchased YouTube. These types of acquisitions, they're strategic, they make sense. But the key is that you have to, again, just like with selling to someone you have a relationship with, is you have to start those discussions early. Obviously, RIM is going through that, and the brick was purchased as well. So all of these discussions, it doesn't just take a month to happen. It's probably in the works for at least 12 months, maybe 18 months, sometimes even longer. So starting these conversations early is another big thing, and you're looking for someone who you have a strategic fit with. The biggest thing here is if you're setting up your business to be acquired or merged with another company, so typically a larger company, what you need to do is make sure that your accounting, your bookkeeping, your paperwork, your legal, and your processes are all in order. And as much as possible, you should be documenting what you do. And the reason being is that a lot of the value of your company is in the intellectual property. So it's how you do things. And so writing things down, having training manuals, having a process in place, these are important things, and when you have them, it's easier to transfer over to someone who buys you, and it increases the chance that someone will be interested in buying you because of your documentation. They're able to realize value from purchasing you earlier. So number 5, initial public offering. So this is an IPO. It's basically selling your shares for the first time. Examples of this, in the last few years, we've had a few large companies like Visa, MasterCard, Facebook, Groupon, all went public. They did the IPO. As you can tell, these are huge companies. The chance of actually having a successful IPO or even getting to the IPO stage is less likely than winning the lottery. So it's very infrequent that we actually get to this one, but it is possible. And then there's smaller ones that you might not have heard of. I mean, a tea company ended up going public. Transportation companies go public. There's lots of reasons why they do this. A big reason is actually the exit strategy. So for Facebook, of course, the CEO, he had a lot of his self-worth was invested in the shares of the organization, and doing an IPO actually gives him cash. So this is an exit strategy. Same with the tea company who went through this as well. And the top thing to know about this is that it is not only tough to go through the IPO process, but the hardest part is getting the value of your shares and what you're going to offer them at correct. And so obviously there's professionals who do this, and working with them, that's something that is top of mind for them. And again, because this is one of the tougher ones to do, this is something that you would be handheld throughout the duration of this process. Someone would help you do this. So these are the top 5 that we talked about. The golden parachutes, basically taking advantage of having your own business by the expenses and big bonuses and rewarding yourself as you're doing it. Liquidation, the assets of your company when you're ready to quit, just selling them. They are worth something. Selling to another entrepreneur that you have a relationship with does take time. Merger or acquisition, making sure that your processes are in place, your documentation is bang on, increases the chance that someone will want to buy you. And finally, the IPO and the fact that this is a less likely one to do, and definitely have the professionals to help you. So the 6th exit strategy that we did not mention is actually building the family empire. So maybe you're building your company not just for yourself, but for future generations. And this is something that a lot of entrepreneurs, what they're looking at doing is creating a Weston, a Rogers, a Leon's, something like that that basically is a family empire and continues to get passed on through the generations. The big thing on this is if this is something that you're looking at doing or you're doing right now, and you'll see this, there's many different organizations that help with succession. And the whole key is if this is something that you're planning on doing, worry about succession early. So who's going to be the next leadership? Is it going to be your kids, or you're going to have to bring in an outside manager? This is a huge consideration, and again, just like with the IPO, there's lots of professional help out there, and it's definitely something that you need to have on your side when you go through this decision. So just a quick wrap up here. If you do want money now, remember, do get a job. Otherwise, if you're starting your own company, remember that you're building equity. Equity is only realized when you have your exit strategies. So this entire video is all about the small business exit strategies, and there's 6 available for you. If you have any questions about anything, please email us at info@smallbusinesssolver.com and find all of our videos training on the smallbusinesssolver.com website, as well as on our YouTube channel. Thank you so much, and have a good one.